March 20th, 2019 to order at 6 o'clock. Roll call, please.
Okay, Mayor Copeland,
Here.
Tom Baylor,
Here.
Ken Jones is absent, Jeff Guard,
Here.
Melina Meyer is absent, Ann Schaefer,
Here.
David Allison,
Here.
and David Gleason.
Here.
That's a quorum.
Okay, thank you. This evening's work session topics are the UBS financial and update on the city's investments, and then BDO's a presentation of the 2017 city audit. So with that, I'd welcome UBS to provide an update. Yeah, and if you could just sit up here, it'd be fine. Thank you.
You got it.
And then just if you'd like to introduce yourself for the record, thanks.
You got it. My name's Chad Adams. I'm with UBS. I'm a first vice president and portfolio manager. We've worked with the city of Cordova for some time now. Oh, there we go. This is my partner, Buck Adams, and father. And he's a senior vice president of investments at UBS. And my objective for tonight was primarily educational and to go through how the city is positioned in the capital markets and what does that really mean. If we're allocating to stocks, if we're allocating to bonds or to cash, what are the characteristics of those and how do they fit together? And I think that this will really help drive the conversation on how much exposure does the city want to have inside the permanent fund to stocks or to alternatives or to fixed income? Because obviously we always want the return that comes with risky assets such as equities, but can we live with the risk? Because I think the fourth quarter showed last year where the global stock market was down 20% over the course of a couple of months. And that's normal. That's expected every year, essentially. That's more normal than what we've experienced over the last few years. And so when we make those allocations to equities, when we allocate on the front end, we want to live with that risk. So if we allocate 100% to stock, let's say with the permanent fund, we're not recommending that. But if we were to make that decision, and I'm just going to use a $10 million number off the top of my head just because it's easier, we would have accepted a drawdown of about $2 million just in a few months. Now, I don't think the city would find that acceptable. So obviously we can't have 100% in stock. So we need to figure out how much is acceptable and how much risk are we really willing to take and expose the city's money to volatile assets in order to get the commensurate better returns that comes with them. Because the conversation that we're going to have during the next big scary market, the next real financial crisis or bear market, isn't going to be one of we need to stop the bleeding. That's a phrase I hope to never hear, because that means we over-allocated to risky assets on the front end. We exposed too much to risk. And when the conversation that we're going to have during the big oopsie, whatever it may be for whatever reason, isn't one of stopping the bleeding. It's going to be, can we go buy? Can we increase the allocation to equities? Because that's when you make all of your money. It's not during a bull market, it's actually during a bear market.
So when Chad uses the term risk, which is a normal terminology in our business, just like physicians have certain terms that we interpret as lay people to mean one thing, and to the physician it means something totally different. The word risk for us isn't loss. So that's something that's really important to understand. Risk is in reality unexpected outcome. How varied could your outcome be? So if you had, a bond that goes up and down 2% a year in price, that's less risky in our world than a stock that goes up, 8% and then down 10 and up 15 and up. It's variability of outcome. That's what risk means to us. It's not, we always interpret it as loss or the risk of loss. But if you have a portfolio that moves around with greater variability than you as the investor can tolerate, or we as portfolio managers think is prudent, then by definition, that's riskier, because almost invariably, it's when you most need the money, because you've had a snowmageddon in Cordova, when you most need the money, also happens to be when the stock market or maybe the bond market or alternatives are down more than is tolerable for you. So what we're always trying to do is to compress the amount of variability in the portfolio so that we know where we'll go when funds are needed. When we're called upon to bring $1 million out of the portfolio we weren't expecting to, where are we going to go to get that? And so when we build these portfolio constructions, they're designed around the needs of the city, not around necessarily where the highest returns are going to come from at any given moment. But you give us the call that says we need $1 million we didn't expect. We need to know where to go, how to get it with the least amount of unexpected outcome for the city.
Yes. And so when it comes to thinking about the equity allocation, and granted, this is temporary, but our rule, the rule that we use is whatever we're going to allocate to stocks. Essentially what we're saying is at some point, for some reason, we're going to go down by half. The stock market will fall down, and now granted, it will come back up, the economy will continue on, the stores will be open tomorrow, and the sun shall rise. But we need to be okay with allocating and accepting that risk on the front end. And now that's different for every investor. And so if we look at this and we say that as a council, as a community, that we can accept during the next crisis for the portfolio to be down by $1 million, $2 million, $3 million, $4 million, whatever the number is, because these are big dollars. So even small fluctuations can be hundreds of thousands of dollars. And so we just have to accept that. Now, granted, what do we get for exposing those assets to more risk? Well, over time, companies generate earnings, and they pass that on to the shareholders. And earnings can grow. That's one of the big differences between a bond. Now, granted, it will come back up $1,000 and pays $50 a year. Stores will be open tomorrow, and the sun shall rise. In 5 years, when that bond matures, it gives you back $1,000 and you got $50 along the way. And now that's the difference with equities is that those companies that are, whether it's dividends or paybacks or however they're passing those funds onto the shareholders, that we can accept distribution can next crisis. And again, we're agnostic on whether it's a dividend or a buyback or any of that. That's a whole nother conversation.
So can we go ahead and kind of dive into how we're allocated
Sure.
and how it's performing? And
Yes, so
get to the meat of what we got here.
Yes, the permanent fund right now has direct equity exposure of 23.85.
Page are you
Oh,
on?
sorry about that. That's on page 10.
Okay, thank you. Might be hidden in the staple, yeah. There
Yes, it's gonna look,
Okay.
This chart.
yes, we have to use pie charts, so just look for that one. So only 2% of the portfolio is in cash. We prefer, especially in a longer term portfolio, to have a low allocation to cash because it's relatively inefficient. Because really what you're going for cash is stability, not necessarily security. Because ultimately over time, inflation erodes the purchasing power of cash. And so the only compensation that we're going to receive there is essentially inflation. If rates are really low, cash yields are low. If inflation is low, cash yields are low. So we try and minimize that. That's really there for us to use as grease in the system if we need to move an investment around, transition from investment A to transition to investment B. The fixed income is the heaviest weighting in the portfolio at, call it 60%. And this is a mixture of government bonds, corporate bonds, so those are debts issued to corporations, and then also mortgages. And then we also have some foreign government bonds in there as well. What we look for from our fixed income portfolio is to generate as efficient and the least amount of volatility that we can get for an income stream. Now, what we don't want to do, what we have to be very careful of in bonds, because especially when we're late cycle in the economy, which is where we are, that doesn't necessarily mean that the market's going down tomorrow. A late cycle can last for years, is we have to not get over our skis. And for the quest for yield, we want to enhance the returns that we're receiving from fixed income. So we start to lend to the lower quality issuers or high yield, which there are times when that's a great strategy, but when we're not being paid you as the investor is not being paid to bear that risk because prices have been bid up too far, now we're exposing ourselves to risk without the promise of return. It's just like with equities when we go into corporate bonds. What you're really looking for is to buy something at a discount. Buy something that you're confident that that yield is going to materialize, but you're taking asymmetric risk, to where the risk is lower than the commensurate reward. And then mortgages is another, we've owned quite a few mortgages because we're not as excited about the corporate market as I hope I conveyed. But in mortgages, we're very comfortable with those exposures right now. And then we have of direct equity exposure about 24%. And that's why during the fourth quarter, when the market was down just shy of 20%, the city didn't fluctuate anywhere near that amount because we don't have that much exposure in equities. Now, this is we've been, and realize that that's a relatively low allocation. It's a matter of when we were having to tap the permanent fund in the past for projects, we didn't want to have the portfolio overly exposed to volatility and risk. And again, anything that we put in there, we need to say that we're okay with losing half at some point before it comes back up again. So this is we don't want to be overexposed there, but we can move that allocation around a little bit. Go ahead.
But you actually have some more exposure to
Yes.
stocks.
Yeah, inside of the non-traditional bucket, which is alternatives, about a third of that is actually additional equity exposure. So we pick some up there, and that's because those are alternative strategies that are based on the stock market. So there's still a component of the tide that moves the market. We call it beta. So inside of there, we account for a third of that essentially being equity exposure. And that's, we can go through more of this, and then if you want to go over the allocations. But as far as last year was a bumpy year across the board, whether it was stocks or bonds. And if you go to page 11, we'll just, next page. So while 2017 was a great year across the board for essentially all assets, for bonds and stocks, where the city permanent fund achieved 11%. 2018 was a difficult year. The stock market was down about 9.41% on the year, and bonds on the last day of the year managed to eke out a 0.01% return. And the city experienced in the permanent fund a down 3.8% fluctuation. And of course, that was when the markets were selling off. It was a bumpy way to end the year. And then so far this year, through this report, through March 11th, we were up $347,000, which is 4.47%. Since the time we sent this report, we're up close to another $80,000 on that. So we've had a nice little run here over the last few days. Will that continue on? We shall see. But for now, we're comfortable with the positioning. And I think really the questions are understanding the characteristics of these different pieces of the stocks and the bonds. And I won't go into the alternatives for right now because that could take an hour. But just understanding those big pieces of equities and fixed income, it's really important to just understand and appreciate how much exposure do we want to those different pieces? How comfortable are we with holding that? Again, because when times are the scariest and volatility is real, we're going to look to the council to allow us to go increase that allocation to equity and step out there. But that's not the time right now.
Would you mind if I gave you a little bit of an analogy that I think is pertinent to Cordova? Do we have a couple of minutes, Mr. Mayor?
Yes.
Yes?
Is that all right, Council? Yeah, sure. Please.
I have to move when I talk. So, if you picture, I mean, Cordova is a community built primarily on fishing revenues, and if you think of cash as fishing from the seawall, from breakwater, you're probably not going to catch a whole lot there. I don't know. You probably look down, oh, it was the best place ever last year, Doug. I don't know. But in general, you're fishing by hand off breakwater. But you can turn around and be home in a couple of minutes with that fish. When you move into fixed income and you move into bonds, you're sending the fleet out a little further. And you're going to areas where normally the fish run pretty well, but you're not that far from home. You're 5, 10, 15, 20 miles out. Stocks, however, where you really want to go get the big fish, they may be out 30, 40 miles. Well, it costs you a lot more money to get there. You're taking more variability or risk, as Chad says, costs more fuel. You get out there, the weather can turn on you. And the city says, you know what, we need those fish right now. So the risk you take is suddenly we've got to turn around and come back to port in bad weather. Maybe we have a mechanical breakdown. The safest place to be at that point would be to just, lay a line and hole up somewhere and wait the weather out. So what Chad is saying is, we always look at these portfolios and we go, okay, we need some money now. Where can we go get it where it's closest to home and there's the least amount of downside for us to bring those fish in, right? Breakwater, you're not going to make much. You go out, sometimes bonds do best and the fish run the best, near to town. Other times stock run better. But the risk that we don't want to take is we don't want to be 30 or 40 miles out and suddenly have, to make it back to town, have to sell out some of the catch, to get back to town. So I don't know if that worked or not, but I had to make it.
Councilman Baylor.
Yeah, so on page 11 there, you've been doing this for 10 years for the?
Mhm.
So I just correct me if I'm wrong, I just added this all up. It looks like you've got an average of 3.161 return.
That sounds about right. When we first started, we were not allowed to have any equities or any corporate bonds at all.
Right.
It was all in shorter term treasuries.
No, I understand. And, if you had been in the market since the 80s, you would have probably averaged about 7%, most people, even with the ups and downs. So you guys are 3.16, you had to be conservative. So from my aspect, I'm more concerned about your average, and I'm not so as far as exactly what you're in, but our risk tolerance is really what I think we should be concerned with.
I agree.
None of us are going to pick what you should be in, but you should understand our risk tolerance and move forward with that.
Yes.
And with that, and maybe now's not time to discuss it, but my wife and I look at ours like every 2 years we do our risk assessment, but we're getting older, your things change. I would throw this out with the city with the government cuts coming on the horizon. Do we need to get more conservative? Are we going to be thinking about we might have to tap into this thing, or do we stay the course with what you got? Other than that, I think that would be, for me, that would be our input. Let you handle, once we tell you where our risk level is, I think you let the professionals manage it.
I agree.
That's my.
Yeah.
That's a longer conversation than we got time for now.
No,
Yeah.
I'm just telling.
But yeah, that's a good point. And I mean, as we just bid off a bond, and that was the other thing, is just kind of maybe a little feedback on where tax-free municipal bonds are. And then there's been a talk on the federal side about eliminating the tax exemption of municipal bonds. And if there's any updates on those, or those are some considerations as we get ready to sell bonds as well. So
Yes.
see what kind of pricing we could expect to get for those.
So currently in the muni market, here over the last couple of years, munis got bid up pretty high. So a lot of them were actually trading at a premium. So an intermediate muni portfolio, and I haven't looked in the last couple of months at muni yields, but we were looking at in the 2.5 range as far as intermediate type muni yields. But that was because a lot of bonds were trading at a premium. Now, one of the risks that comes into munis after post-issue is what's called spread widening. And that's because you have a credit rating. Every issuer has a credit rating. And who owns municipal bonds? It's typically not institutional investors or insurance companies. It's usually individuals. And so there is a component of when there are economic difficulties and spreads widen. What that means is that investors demand a higher return from their existing bonds. And what does that mean? The price goes down. But right now, that's not necessarily the case. Most munis are trading at a premium, and I would say they're trading right in line with where treasuries are. So from an investor standpoint, there are other places to go, but as far as issuing a muni, I'm not a municipal advisor. We have to make sure that we don't cross that line. That's for you to work out with your municipal advisor. But just from the capital market perspective, that's really what we're seeing. And that's that's one of the risks, is if there's some spread widening that goes on from here to when you issue, you're probably fine for a while, but eventually, if economic challenges do materialize and we go from slowing down on growth to contracting growth, then you may see spread widening where investors demand higher returns. But right now, spreads are pretty tight. Investors are not demanding a really high return on municipal money. I hope that made some sort of sense. I apologize if I was unclear.
Okay. So we kind of interrupted, but you were kind of walking through the asset allocation as it is.
Mhm.
And, so would this be a good time to just take questions from council, or?
Sure.
Just a comment is what I was driving at is to achieve that 7% return on the last 30 years, you would be taking some risk. You'd be in some stocks and beyond.
Yes.
So if you're going to be returning 4% average, from my standpoint, I would be happy with that, because that means you're kind of in the middle of the road. We're not hitting the lows, we're not hitting the highs, but we're where we need to be for what I would think the city's risk tolerance. So that was my comment.
Okay. And maybe in a different conversation, we can go through how to build an asset allocation forecast and look at if we have a target return or a target risk based on where things are right now with bonds, with equity valuations, with all of that. We can build, back our way into an asset allocation that way. So there are ways for us to do that using what are called capital market assumptions, and I would put everyone to sleep in this room if we went through that. But we can do that at a later date. I'm perfectly happy to.
Council, other comments or questions? So we are, I think, just kind of globally, we have a fair amount of debt, and we have some small bonds maturing, but we are concerned with some of the state pass-through costs. I mean, especially, the marine highway system is more of a global economics, but as far as our school bond debt reimbursement from the state, that's definitely in play. And just from Bitney's latest update today, he thinks that's actually a bigger concern than the marine highway system right now. He thinks there may be some change. It's just a question of how much, but that's a risk. And then as we take on a large capital project like a harbor rebuild, and it may be a little more conservative.
Gotcha.
So.
Well, and something we could build in would be if there was let's say a dollar amount, whatever that dollar amount is, 1 million, 2 million, whatever that dollar amount would be that may need to be tapped, but not planning to tap it. That's not the objective, but maybe we could cordon that off, and we would have a maximum set risk on that. Would be fairly limited. Hey, we can't have this thing fluctuate more than a few percent. Because when we come and say we need X dollars, we need it to be X, not X minus Y. We can do that, but because it's not a definite expense, we can still expose it to fixed income, maybe give it the opportunity to earn some yield, but just not take too much risk with it. And we can do that. I mean, it's not difficult for us to open up another account or different label. However that needs to be done, we can do that.
And we also have the central treasury account, which is not reflected on here. There's $1 million sitting in central treasury. So just to bring that back to the forefront, that sits there. And we have had, in the past, unexpectedly received calls to say, hey, it turns out we are going to need money from the permanent fund. And so despite, those fairly substantial withdrawals, which come at unexpected times, we've still managed, as you said, to make that return net, taking as little variability, as little risk as we possibly can, but we're always cognizant of the fact that things happen, especially in municipalities. Things happen, or in life, illness in the family that people weren't expecting.
Yeah.
So.
And that's why with the permanent fund, there is I would define a minimum risk portfolio, because if we're looking at a mixture of stocks and bonds, it's not actually 100% in bonds. It's about 15% towards stocks, because bonds have their own internal risk characteristics, and adding in some equities to an overall bond portfolio actually reduces your overall degree of variance. And so it's just so if we are relatively close, we're not all the way at it at a minimum risk portfolio, but if as the council talks, if you decide that, hey, we need a more aggressive risk posture or even more conservative posture, or hey, we do want to have a carve out of some of this that's going to be as low risk as possible, we can do all of these things. And so we're flexible, we can work with you, and we are happy to have this be, and we prefer it to be a collaborative process.
So on the tie, just to kind of tie sheet 10 to 11, for instance, on the benchmarks down here, are you just benchmarking our portfolio, or are these actual investments down here? On
Those are just benchmarks. So the MSCI, if you look over on the left side, the All Country World Index, that is the global stock market. And then below, at the very bottom, the HRFX Global Hedge Fund, because we also benchmark ourselves against hedge funds as well, to see how we stack up relative to, because that's who we compare ourselves against. And so those are real benchmarks right down there.
And then I heard you say this, our current asset allocation, you wouldn't call it a minimum risk, but we're kind of close.
Yeah, moderately conservative.
So, okay. Other questions, council, or comments? Did you have kind of a summary, or you want to?
We know that we had about 20 minutes. And
Yeah, so we wanted to keep it short.
Be respectful of that.
Okay, great. Well, thank you very much. Appreciate the update and feedback.
We're meeting with 10 city employees tomorrow for personal private financial counseling.
Okay, fantastic. Thank you. Okay, so the next work session topic is the presentation of the audit. And Manager Lanning, did you want to?
Well, we have BK here from BDO, and he's going to go through the audit with Dean. Dean, you can sit right here if you want. That's appropriate.
All right.
I know we have questions. This is the 17 audit. 18 will be underway soon, and you can ask all the questions that you like.
All right. My name is Vicky Srestha. I'm from BDO. I just took over the account for this back in December this year. So I'm a new partner at BDO. I've been with the firm between BDO and Mikunda for the last 15 years or so. And I became a partner as of July 1st, 2018. So I'm new to this process. So this particular account is new to me, but I've had Steve Stancina. He was the manager on this job. He's been helping me with this. I was hoping to have him over here, but right now he's on vacation down in Nashville, so I'm here. So anyways, just giving you an update, Leah Patton was the original partner on this job. Most of the audit happened during her time. And then basically we did most of the field work in April and May of last year. And then after that, basically we were just waiting for the medical center audit to be completed. And then towards the end of December, that audit was completed. But by that time, it was already in the situation where we are already deep into our other busy season, so it was hard to free up resources. So now we're working on completing the audit, and we're getting pretty close, and the numbers in the financials that are here are pretty close to being completed. So I don't think we should have any adjustment beyond what's already in the financials right now. So first of all, I have a couple of documents. One of them is the audit wrap-up document. So that's the document I was going to go through first.
Okay.
And then on that audit wrap-up document, I can go to the page 3, which is the status of our audit. So at this point, we've substantially completed our audit of the financial statements, and our audit is done in accordance with government auditing standards. So since you get funding from federal and state sources, anytime you get more than $750,000 of federal funding, then you're subject to the federal single audit. Anytime you get more than $750,000 in state funding, then you're subject to the state single audit. So in your case, you're subject to both the federal and state single audit. So that's also part of the work that we did. The first bullet point over there, the objective of our audit is to obtain a reasonable but not absolute assurance about whether the financial statements are free from material misstatements. So when we come to an audit, there's no way we can look at each and everything, right? So there's a lot of information that goes in the trial balance. So we take a risk assessment kind of approach. So based on any kind of qualitative and quantitative risk, we choose the accounts and the way we audit. So it's a risk-based approach. So based on that, we look at certain transactions. And so that's why we say it's not absolute assurance about the financial statement, but it's a reasonable assurance. So we plan and issue an unmodified or a clean opinion by the time it's all done. And all records that we requested was freely available to us, and management cooperation was excellent throughout the whole process. So it was not management that caused us the problem as far as getting the data to complete the audit. Next page is the results of our audit. On here, there's the one thing I do want to point out is there are some recently issued accounting pronouncements that you'll find in the financial statements. Of those, the one that is going to be important for the for the 12/31/18 year end will be the implementation of GASB 75. GASB 75, so a few years ago, like 2 or 3 years ago, you had GASB 68 was applicable, and then you had to bring in your pension portion of your liability to your books. I think that number is right now sitting at about $10.6 million. And in 2018, you will also be required to bring in the health insurance portion of the liability onto your books. So that will be a new item for 2018 audit. And I should warn you from the beginning, back in 2015 when GASB 68 did come out, there was a major delay in when the numbers were finalized. So all the audits were pretty much the whole state of Alaska, like everything was delayed. So nothing got printed basically until a year after year end, basically. So anyway, so I hope that's not going to be what happens with GASB 75. The cities and school districts that were June 30 year end already had to adopt 75, and the report came out. So I'm hoping for 12/31 there's not a significant delay, but just based on history, you'd think at least July before those numbers are finalized, but I can't guarantee that one. So that's going to be for next year. That might be one of the holdups that can happen for FY18. Significant estimates, accounting estimates in the financial statements, your collectibility of your accounts receivable. A lot of your receivables are from granting agencies, so there's no real risk over there. But any other receivables for your water, your refuse, or those kind of funds, then you could have some risk, and you have booked some allowance on some of those amounts. Then you have your landfill closure, post-closure liability. I think you recorded close to between 800 and 900,000 of that. And then, like we talked about, your pension liability, that you don't have any control over those amounts. All you can do right now is like pay the required rate. So you have to pay 22% of your employees' payroll into PERS. And then the state at the end of the year gives you the number that should be your liability, and that's an allocation that's done throughout the whole state. And then you also added, in the last couple of years, you added your self-insurance liability. So you're self-insured for health insurance now, and then so that liability is also on the book. And I think at the end of 2017, it was sitting right around $722,000. And then you didn't make any significant changes to your processes or assumption in calculating your significant estimates in 2017. Next page, result of our audit. And in this part, we talk about correct. Oh,
Page is this we're on? We say next and next.
oh, I'm sorry. Page 5 of the audit wrap-up document.
Where's the audit record?
That's a handout here, this audit wrap-up.
Oh, I never got that one. Okay, that's why I can't.
Yeah, sorry.
Okay, thank you.
Oh, you got another one?
Thank you very much.
Yeah, feel free to stop me if I'm going too fast, or or if I'm going too slow, you can tell me to speed up too.
All right. I think you're on a good pace.
Okay.
So we're on page 5?
Mhm.
Okay, thanks.
So this one, we talk about corrected and uncorrected misstatements. As part of our audit, we have to report to you any corrected and uncorrected misstatements. Corrected misstatements are items that we found during the audit, and then management has also agreed with it and booked the adjustment. And uncorrected misstatements are items that are small enough that we don't really consider it to be a problem if you don't book it. But if it's above a certain amount, we still have to report it to you, just letting you know that they haven't booked that adjustment. So, and those are actually, if you look at the last 2 pages in this report, you'll actually find the listing of the corrected and uncorrected misstatements. I'm not gonna really go through them all, but I have that summarized here, but I just wanted to point out that it's in there, so for your information. So as far as corrected misstatements, there was corrections on depreciation expense, allowance for doubtful accounts, accrued interest, and some transfers and due to froms, and your internal fund balance between your different funds. As far as uncorrected misstatement, those were not that big of a deal. If you look at the entries, the biggest item over there is just your self-insure. Since you're insured for health insurance, when you adjust that liability, so basically what happens is, as throughout the year you pay for your health insurance, and at the end of the year you have to calculate out, okay, so all of these people have already had some kind of health issues that they're going to be claiming in the next few months for injury or whatever that has already happened before your year end. So you have to come up with an estimate for that amount, and that is done based on your third-party administrator. They provide, it's called an IBNR report, incurred but not reported, and based on that, that liability is calculated. But so as far as that, any change in that liability based on that calculation was all posted to the general fund instead of allocating out to all the different funds. So that's the major portion of your uncorrected misstatements. So the expense is there, it's just not in every fund.
In the right,
Incurred but not reported?
Yep.
IBNO, okay.
Yeah.
and basically that was all put in the general fund instead of distributed among the buckets that it
Yeah,
should have been.
and that's what the internal, exactly. That's the past adjustment or uncorrected misstatements. Next page is the quality of the city's financial reporting process. Over here, no new accounting pronouncements in 2017, but like I said, in 2018, you will have a big one. And based on what I've seen, it's pretty much 20 to 30, what you would expect for that health insurance portion of the liability is pretty much about 20 to 30% of what your pension liability is currently, but I don't know that completely yet. And then there's no alternative accounting treatments that management has used that we know of. And then the next one is group audit. As the financial statements includes the city's financial statements, and it also includes the school district's financial statements, and it also includes Cordova Community Medical Center, which is presented as a blended component unit. So it's actually part of your financial statements, but we didn't audit that entity. Next page is the internal control over financial reporting. When we do an audit in accordance with government accounting standards, we actually have to go understand your controls. And then since you are subject to single audit requirements, both from federal and state side, as far as any expenditures or any that's passed through those federal and state programs, they want us to come and test the compliance and then test the controls over compliance. So as part of our audit, we also test that. We test the design and we pick a sample and see if you are following your controls as you go along. So when we do that process, we actually we put any kind of deficiency that we find as part of our audit into three different buckets that's defined over here. A deficiency in internal control, a significant deficiency, and material weaknesses. So material weaknesses are deficiencies that are so big that when we look at it, like it would cause a material misstatement on your financial statements. So anything of that nature, we have to report to you. As deficiency in internal control is just small deficiencies that could aggregate together to become material weaknesses, or it's just small enough that there's no real chance of big misstatements coming out of it. And anything in between would be a significant deficiency. So out of these three group, anything that's significant deficiency and material weaknesses, we actually have to have it in writing to the board, to the board. And then control deficiencies are something that we could just discuss with management, or if they wanted, you could also have that in writing. So as part of this process, for this year, we are reporting 2 material weaknesses and then 3 significant deficiencies. And on that note, I would actually like to just address that right now, and we can actually go to the financial statements and show where that information is. So if you take the financial statements, it's towards the back. We go to page 112. Page 112.
Yeah.
Yeah.
Did I put those numbers on it? To the ones you got it?
I've got a 112.
Is it in
Yeah, it's in here.
page?
No, it's
Okay.
there.
99.
Yeah. Oh, is it?
I've got 2 numbers.
I don't think she copied that page.
Oh, page 112. Oh,
The same? Yeah. Yep. Got it. Thank you.
oh no. All right.
Nobody has page 112?
No, I have
They
it.
do. If they have the full work session packet, it's 112.
Mhm.
Plus have the audit packet.
All right,
Here, you can just go over this. There,
he's got it. Just on top of it here.
Does anybody over there need to look at it? I've got it right here.
15 months
It's
old.
the one
I
on the
don't
bottom,
care, look
center
at
at the bottom. Yep.
Sorry.
Yeah. Okay.
We
no.
got a deficiency.
Yeah.
That's our deficiency. Our page numbering deficiency.
Well, page 112 just summarizes the results of the audit. So it's a good page to go to see what has happened, and if we're reporting anything, that should show up right there. So the first part right there, financials, so it's divided into 3 different parts: financial statements, federal awards, and state financial assistance. So for the financial statements, we are issuing an unmodified opinion. We are reporting material weaknesses and significant deficiencies for financial statement purposes. For the federal award, there's no material weaknesses or significant deficiencies reported, and it's an unmodified opinion. And for the state award, same thing, no material weaknesses or significant deficiencies, and unmodified opinion. Oh, actually, this dollar threshold for the 500,000, it was for the 2017 audit. For the 2018 audit, they moved it up to 750,000 for state. So I jumped the gun over there. And then the next page, 113, has the 2 material weaknesses. The main thing to note on that is these 2 material weaknesses have nothing to do with the city. Both of these are related to the medical center, and this is what the other auditors that audited the medical center reported. So basically, we just had to take the findings and put it in here. The first one is adjusting journal entries and lack of account reconciliation. I think the major problem over there was the cash accounts were not reconciled until I don't know the exact date. Until September of 2018 for the 12/31 period, and that was the main cause of the delay in the audit. Because when cash is not reconciled, that means majority of all your other accounts are not reconciled either. Because in order for those accounts to be reconciled, cash has to be reconciled first. So that was the main finding. The second one was tracking of expenditure related to some state funds, and they had some issues over there where some unallowable costs were charged to the grants, and they actually had a payable at year end to the city for that. Next finding, the next three findings, actually the next two findings are related to the city, and these are significant deficiencies. And basically an internal control process basically requires some kind of control over journal entries and financial reporting. So any account reconciliation. What was happening in the city during 17 is because of the lack of staff or lack of knowledge on who can actually review some of those items. So the finance director was preparing journal entry, but there was nobody reviewing it. And then same thing on the next one, some of the accounts reconciliations were being performed at the higher level, but there was nobody else to review it after year end. And then we did find some journal entries as a result of some of the account reconciliation process. So that's why that's reported as a finding. And then the last one, 2017.05, that's just a bummer finding there, but because that's basically you have until 9 months after year end to file your federal single audit. And if you don't do that, then you become basically a high-risk auditee for next year. So with the medical center not being even close to being printed at that point, you already did not meet that requirement. So that's just been presented as the finding. So. And those are the 5 findings we have for this year.
Can I ask one quick question about
Yes.
that on the last stuff you said? You said we automatically go into being a high risk.
Well, that's
the next
just
year?
that's just for, so whenever you have a material weakness in financial reporting or you don't file the single audit report in time, it makes you a high risk auditee, and that's just for auditing purposes. So what that means really is, so when we come to do a federal single audit, basically they have this risk assessment criteria where, okay, so these are all the federal fundings that you got. And then based on a dollar threshold, certain programs are considered type A programs, certain programs are considered type B programs, and the rest are just lumped into the rest of the programs. So, and then, the difference between a high risk and a low risk auditee is a low risk auditee, as far as compliance test work, we have to get 20% coverage. When you are a high risk auditee, you have to get 40% coverage. So that's the main difference. So that would be the only thing that it affects. And once you're a high risk auditee, basically it's like 2 years that you stay like that, and then you can move on after that.
Okay, and how does that affect us financially for the cost of getting an audit?
I don't think it's gonna have a material effect. It's just based on what kind of federal funding that you get. So I believe you only had one type A program, and then if we audit that one program again, you're still gonna be over the 40%. So it wouldn't have any real effect as far as audit work. But it could be different if that was not the case. So.
The single audit is a fairly small component in relation to the overall audit.
No. Single audit is a big part of, as far as
Fairly
our work
Okay.
is concerned. We have to spend a significant amount of time
Okay.
in single audit work.
Other questions, council? Got a little pause.
So,
I just wanted to circle back to the GASB real quickly. So that GASB 68, was the delays mostly due to the accounting firms, applying all the provisions of the new standards, or?
no, the delay, basically, we cannot put an opinion on the financials until the audit report for PERS is completed.
Okay, I see.
So they already had draft numbers. Usually what happens is they give you draft numbers and they say this may or may not change, but it hasn't changed so far. So we get the draft numbers and already put it into the financials, but we cannot print and give an opinion until they finalize their audit.
Okay.
Yeah.
So the state is slow in that
Yes.
regard, or was.
Yeah.
So what is, and the 75 is about health insurance?
Health, it's the healthcare portion of your pension.
Who's going to be getting us those numbers?
The state.
Oh, the state will.
Yeah. Well, I don't think it's going to be anything like what happened in 2015 because that year there was a lot more back and forth going on between even the auditors and the PERS department as to treatment of a lot of items, and so all that had to be resolved before they could give an opinion. Now it's a little bit different story now already because they've already learned their lesson from that, I hope.
But there's also a
So-
lot fewer of them there now.
Oh, yes, that's also the case.
Okay, thank you.
Yep. So moving on to the next part, we did put a couple of the control deficiencies in here if you wanted to look at it. It's just related to passwords, just making sure that city employees are changing their passwords from time to time. And then the other item is the segregation of duties. There are like multiple users with access to your accounting software, and really that access should be a little bit limited is what we are suggesting over there. And the next one is other required communication. Really not much to report. I've already talked to you about the delay in the audit, so that would be the only thing over here. And after that, you'll find like a draft representation letter that management will eventually sign once we're ready to complete the audit. And that's all I have on the audit wrap-up document. I do have the financials here. If there are certain things in the financials that you'd like me to go over, we can do that. Otherwise, I can at least just go over the main balance sheet and a couple of the income statement with you if you want.
Okay, any questions, council, or?
Maybe this is,
Vicky.
how do we make sure that we're not getting stuck in the barrel we did of being a year and a half late in our audit? I mean, I understand audits have purposes for certifying to other agencies that are giving us money
Yeah.
for pass-through dollars that we need to prove to them that we're doing stuff. But it's
Sure.
also used by us to help build future budgets. And if we're getting it a year and a half late, it's kind of hard to do anything with it that makes any sense.
Well, the biggest issue over here this year was not getting the medical center audit in time because the plan was for us to actually wrap up end of September. The plan was to actually wrap up way before that, but really end of September is what we are shooting for after the medical center report wasn't available. But after that, really, the information didn't come till December, end of December, by which time, like I was saying, we were already knee-deep, and then finding the resources to finish was a problem. But this year, you have different finance department people, and I think that could make a big difference. But then the main thing is like just going to make sure that the medical center audit is completed. Now, if all of that information is available, let's say in June, then there's no reason we would, and then if the GASB 75 information is already available, there's no reason for us to not have this printed like anything beyond like July or something like that. So,
Okay.
so even if you look at the history of when the financial statements are printed, I think 2015 or whatever will be an anomaly because we had the 68, but every other time I don't think it's ever been this late. So, and this one was also, it's a lot of things did happen this year between that not being available and plus the partner on the job not being here after that information was available. So it was a storm of events, I guess.
I understand. How often do clients change partners that are servicing them? How long a tenure do partners usually have?
It depends, but normally once you take over an account, you actually stick to it for as long as it. So I think John was probably the one that was handling this account, and he probably did it for I don't know however many years. Yeah, and then
Okay.
after he retired, it was a couple of different people, and we did have some transition after moving to BDO, but we're stable now, so So, yeah.
You gonna be there a while, Vicky?
Yeah, yeah.
All
Well,
right.
I'm planning on it so far, so. Yeah.
Other questions, council? Okay, see, you want to just do a kind of a quick rundown on the financial statement?
Yeah, I'll at least go through the balance sheet, just show you what your assets, your liabilities, and everything are looking right now, so. So if you go to page 6, by the way, these financials might look a little bit different this year. State is requiring you to have financial statements in 9 font or bigger. So we still actually have to make a little bit of formatting changes over here, but normally your assets and liabilities were always presented in 1 page, but we had to break it out and put it into 2 pages because of that requirement too. So it was really getting small that you couldn't even see those numbers before. So if you go to page 6, and if you want, I mean, if it's easy, then you can put 6 and 7 side by side. But so your statement of net, this is your statement of net position. Statement of net position is basically your balance sheet. A for-profit organization, that would be your balance sheet. And over here, you'll find your assets, everything that you own, liabilities, everything that you owe, and the difference between your assets and liability, that's your net position or your equity, right? Your total assets between your governmental activities and business type activities at the end of 2017 was 113.5 million. Majority of that, about 94.5 million, was in capital assets. And then 14.6 million was in cash and investments.
I'm lost.
Next page.
I'm sorry, I'm not finding
It's
it.
Oh,
page 6
total.
there.
Page
115 million, right here.
Go 4 numbers above that.
I'll look on his. Thank you.
Yeah.
Here's his.
Yeah, that's why I'm lost. All right, we got it.
Yep. So that's where you are at 113 million with 94.5 million in capital assets and 14.6 million in cash and investments.
I'll look.
Okay.
As far as your liabilities go, $37.1 million in total liabilities between governmental activities and business type activities. A big chunk of that liabilities, 10.1 million, is your pension liability. As far as that liability goes, that doesn't really come due right away, right? So you're just paying in 22% for your employee's paycheck.
So
But that's
what
about it.
freezes over?
That's about the extent of it right now. And whenever it goes away, it goes away. So it's going to take a while. And then the rest of it mostly is your loans. There's, I think, about $19.6 million of general obligation loans and regular loans over there. 16.2 million of that is in the governmental activities, and 3.3 million is in your business type activities. I think most of your business type activities is related to your water fund. And then your governmental ones, I think, is mostly the school bonds. With that, those numbers, that leaves you with your net position of 76.8 million. And out of that 76.8 million, 72.7 million is invested in your property and equipment. So it's non-liquid, basically.
Is that 10 million in pension, does that include the hospital, or is that just?
Oh,
That one does include the hospital because, yes, because the hospital is included in your governmental activities since it's a blended component unit.
Is the hospital, oh, I'm sorry, is that the hospital, 4 million for the hospital?
They have a 4 million.
Okay.
Oh,
That's the school. 4.5 million is the school. I can tell you what the breakdown for the hospital versus the city is. It's actually in the financial
I
statements.
would like to hear that, because we've been using a number, we've been given a number when we were doing
Yeah.
work on the healthcare, the
Yeah.
hospital being 17 million.
Exactly.
Well, no. Page 40 of the financial statements.
I'm done.
We'll see if my 40 matches up.
Shows you the breakdown of the 10.1 million. So 6.1 is the city portion and $4 million is the hospital's portion.
Now I'm not there. 40 is the page we're on?
Page 40, yes.
So where's the school at?
School is at 4 million too. That's on, the school's portion is actually
Reading
on.
across, not down.
So the medical center's 4.
Mhm.
Well, that's a lot less than what I was led to believe.
But is that the same number we're thinking it is?
Yeah, I don't think that's the same number you're thinking of. This 4 million is just the pension portion of the liability, and they might have other things.
Right.
Yeah, but that's what PERS is, isn't it?
Yeah, PERS. Yeah, it's not, so it's,
Ah, okay.
it's not 17 million according to the, the financial statement that we got for them. So there's no way it can be 70, there's no way they can be more than you guys. Unless there's a lot more employees there.
Okay.
But, yeah. But I'm confused. I thought we were-
These are count the arrears and everything too? Because,
Yeah, it does, but the way the allocation of that liability is, I don't know the exact allocation way they do, and it is kind of based on your current number of employees too. It does not necessarily mean you had 500 employees before and now you have 100 employees, but you still have those 500 people. That's not the way the allocation is done.
so if we wanted to close out all the city's liability for that, pay the state $4 million and be done with it?
That's not even really an option because you're part of a pool. It's called a cost sharing pool. So that's not even really an option on the table.
Well, I'm not saying we're gonna do it, but I'm
Yeah.
saying that would pay off the
Yeah,
liability.
if you could do that, that's what would take you to get rid of the but not necessarily, because that liability is based on a lot of different factors, right? So longevity, market rate. So this liability is based on an 8% rate of return on the market. Mortality rate, all kinds of things go into that factor. So if the market doesn't do that well next year, this liability, even if you pay down, could go to $10 million. So it's not that straightforward.
So you can never get out of,
Yeah, I mean, other than the state just saying we're gonna assume it or something like that. So you're just gonna pay your 22%. So the way you get out of it is, as of 2006, nobody can enter into the defined benefit pool. So the way you get out of it is after all of the people that are the tier 1, 2, 3 have
After we're all
moved on. Yes, exactly.
So we're liable for everybody up to 2006.
Exactly. Yeah, anybody that got hired after 2006 fell into your defined contribution plan.
Okay, council, we're up on meeting time. Any other wrap-up questions or? Okay, so I think we're hearing that we're going to get the audit in a more timely manner.
Yeah, but this year, I should warn you, it'll be another couple of weeks, maybe 3 weeks at the max before we can finish, but we will be done, and then we'll move on to the next year's audit.
All right, thank you.
Thank you.
Okay, so with that, we'll adjourn the work session.